Hello and welcome. You pulled into a gas station this week. You looked at the price, and for a second, just for a second, you did the math in your head. How much is this thing going to cost me? Can I put in less today and come back later? Maybe you have started skipping the highways and taking back roads. Maybe you have noticed that your grocery bill creeping up $10 here, $20 there, and you cannot quite figure it out why. Maybe your mortgage payment adjusted and nobody gave you heads up or any warning. You are not imagining it. You are not bad at math or budgeting. This is a system hidden in plain sight that quietly decides that the price of your gas, your food, your home loan, and your retirement savings. And right now, with American forces engaged in Iran-Israel war and missiles flying over the Strait of Hormuz, that system is running hotter than it has in almost 2 decades. It is called the derivatives market, and in next 10 minutes, you are going to understand it better than most people on Wall Street want you to. February 28, 2026, US and Israeli forces launched strikes on Iranian military infrastructure. We all know that. Iran responded within 48 hours. They did not just fire back with missiles. What they did, they moved to choke the Strait of Hormuz, a narrow passage of water between Iran and Oman, barely 21 mile wide at its narrowest point. I have made videos on it. You can refer to those videos. That stretch of ocean carries 20% of the world's oil supply. 1/5 of all the oil on earth passes through that narrow gap every single day. And up till you know all these details. When Iran threatened it, oil prices spiked overnight, not because the oil was gone, but because of the bets. Yes, trillions of dollars in financial contracts called derivatives instantly repriced. Traders, hedge funds, and big banks had placed enormous wagers on what oil would cost. When the war headlines hit, those bets exploded. Prices moved fast. And somewhere in Ohio, Chicago, or Washington, D.C., a dad filling up his pickup trucks stared at the number climbing on the pump and had no idea that a financial contract made in an office tower in Manhattan had just changed his morning. Okay, let's slow down for a second because I'm going to explain derivatives to you the way nobody ever has. Not like a textbook, like your next door neighbor. So, let's dive in. Imagine you are a farmer in Kansas. You have planted corn. It's June. Your harvest won't come until October. But you have got bills right now. Mortgage, equipment loans, kids in the school, and you are terrified that by October corn prices might crash and 4 months of back-breaking work won't cover your costs. So you make a deal today. You shake hands with a buyer, maybe a cereal company or company that makes something out of corn, and you agree, I will sell you my corn in October at today's price. Locked in, done. The deal, that's a derivative. Its value comes from something else, in this case from corn. You are not selling the corn today. You are selling a promise about the corn. That farmer can now sleep at night peacefully. The cereal company can plan its costs. Everybody wins, and it's a win-win situation for everyone. That's the beautiful original idea behind derivatives. Farmers invented this, not the Wall Street. Now here is where it gets interesting and little scary as well. Wall Street, what it did, Wall Street took that simple idea and built something almost incomprehensibly large out of it. As of mid 2025, the global derivatives market had a notional value of 846 trillion US dollars. 846 trillion. To put that in perspective, the entire US economy, every car sold, every house built, every dollar earned by every American in a full year, that's about 27 trillion. The derivatives market is more than 30 times that size. And four US banks, just four, control over 85% of the derivatives held by American financial institutions. And these banks are Goldman's 53.2 trillion, Citibank 50.8 trillion, JP Morgan Chase Bank 50.2 trillion, and Bank of America that holds 22.8 trillion. Now, does that mean 846 trillion is actually at risk of disappearing? No, not at all. That number is the face value of all the contracts, or in simple words, bets, not the real money riding on them. Think of it like this: if you and your buddy bet $100 on the Super Bowl, the notional value of that bet is $100, but the real money that actually changes hands is somewhere between $0 and $100, depending on who wins. In derivatives, the real exposure is usually 1 to 5% of the notional value. But here is the catch. When markets go haywire like they do during a war, that small percentage can explode into something that shakes the entire financial system. You have never signed a derivatives contract, and you probably never even said the word derivatives out loud. But I promise you that this market is inside your daily life right now. Let's walk through your single day. You wake up and fill your car. The price of that gas was shaped by oil futures, a type of derivative, traded the night before on exchanges in New York and London. When war broke out and Hormuz got tense, oil futures spiked. Your pump felt it within days. To stop at a drive-thru, that hamburger costs more than it did 2 years ago. Beef prices, wheat for the bun, diesel for the delivery truck, all of it is hedged with derivatives. When energy costs rise because of war volatility, those hedges get more expensive and the food company passes the cost to you, to the customer. You check your mortgage statement. If you have an adjustable rate mortgage, your interest rate is tied to financial benchmarks that are directly influenced by interest rate swaps. One of the biggest categories of derivatives are swaps. When the Fed raises rates to fight war-driven inflation, those swaps reprice. Your monthly payment goes up. Nobody calls to explain why. You glance at your 401k, the mutual funds inside it hold stocks in companies that use derivatives to hedge their costs. When the derivatives market gets volatile, those companies' values swing. And with that, your retirement account swings with them as well. From the pump to the plate to the mortgage to the retirement account, derivatives are everywhere in your financial life. Invisible, powerful, and right now supercharged by this war. Now I want to be fair to this market as well, because it isn't all bad. In fact, without derivatives, your life would probably be harder and more expensive. Here is what I mean. Let's talk about Delta Airlines. Delta Airlines burns billions of gallons of jet fuel every year. If they could not hedge oil prices with futures contracts, every time Iran did something that spiked oil, Delta's costs would explode. They would have two choices: go bankrupt or raise your plane ticket price dramatically. Because they can hedge, because derivatives are there, your flight stays more affordable even when the Middle Eastern oil is expensive or Middle East is on fire. Same for a small manufacturing company in Michigan or Oregon. They buy steel from abroad, they sell it in US dollars. They need to borrow money to grow. Derivatives let them lock in steel prices, hedge currency swings, and manage interest rates risk. Without them, the uncertainty alone would stop them from hiring. A landmark study found that derivatives activity added roughly $149 billion to US economic output over a single decade and supported over 530,000 American jobs. These were not Wall Street jobs, these were factory jobs, farm jobs, and small businesses jobs like on McDonald's or on other fast food chains. So derivatives used correctly are risk shock absorbers for the entire economy. They let businesses make long-term plans in an uncertain world. They keep credit flowing and they keep prices stable and workers employed. But what is the problem? The problem is, and it is a big problem, is what happens when they stop being used correctly. Let's talk about 2008. Let's go back there for a second because most Americans lived through it and do not fully understand what caused it. I'm talking about 2008 crash. Banks had created a type of derivative called a credit default swap. It was supposed to be insurance against mortgage loans that are going bad. But instead of managing risk, they used it to make enormous leverage bets on the housing market. When the housing prices fell, those bets blew up. AIG, one of the largest insurance companies in America, had to be bailed out with $182 billion of your tax money. Lehman Brothers collapsed overnight. 8 million Americans lost their jobs. 10 millions lost their homes. Why? Not because of anything they did wrong. Because a financial instrument used recklessly in an office tower in Manhattan detonated the entire economy. That was the reason. The government passed reforms laws after that and the system got safer. But here is what they did not fix. Let's talk about it. The market is now vastly larger than it was in 2008. The same 4 banks are even more dominant, and a war just lit a match under it. Here is what's happening right now in 2026. Iran's disruption of the Strait of Hormuz sent oil volatility soaring. Speculators, hedge funds, prop traders, algorithm-driven systems piled into oil derivatives. Not to protect against risk, to profit from chaos. Oil spiked, gasoline spiked, then came the chain reaction. Higher oil means higher shipping costs. Higher shipping costs means higher prices on everything in the store right next to your home. Economists estimate that sustained $100 per barrel oil adds 0.5 to 1% to US inflation on top of whatever was already there. That sounds small, but that's the difference between 2.4% inflation rate and a 3.41. That's an extra $1,200 to $1,500 out of the average American family's pocket every year. And then there is the dollar. Here is a fact that most Americans do not know. Since the early 1970s, oil has been priced and traded globally in US dollar. This arrangement called the petrodollar system. I have made a separate video on petrodollar. You can refer to that video on my channel. So America invented the petrodollar system, and it's a massive and invisible advantage for America. It means the world needs dollars to buy oil than they would have otherwise be. Iran is now pushing oil deals priced in other currencies. China and several Gulf states are quietly exploring the same option. This war is accelerating what economists call de-dollarization. If the dollar loses even part of its petrodollar status, here is what happens to you. Import prices go up, inflation gets harder to control. The government has to pay more interest on its 36 trillion national debt. That means less money for social security, Medicare, roads, schools, and higher taxes or cuts coming for regular Americans. Derivatives on currencies and interest rates are magnifying all of this, amplifying every swing, making every shock hit harder and faster. After 2008, Congress passed the Dodd-Frank Act. The idea was simple: make the derivatives market safer by forcing more trades out into the open, onto exchanges where regulators could see them. And it worked. Partially, counterparty risks, the risk that the person on the other side of your bet cannot pay, dropped significantly. More trades now flow through central clearing houses that stand between the two sides and guarantee payments. Trillions in custom private contracts still trade off exchange. Nobody can see them. They are hidden. AI-driven trading systems now move markets in milliseconds, faster than any human regulator can respond. And a prolonged Middle East war introduces risks that no model has been tested against. What happens if a cyber attack hits energy derivatives infrastructure? What if a major clearinghouse gets overwhelmed by simultaneous claims during a massive price spike? The system is safer than it was in 2008, but it is not bulletproof. And the stress test it is currently facing, war inflation, de-dollarization, and 846 trillions in interconnected contracts, is unlike anything it's faced before. So let me leave you with this. You are not a passive bystander in this story. Every tank of gas, every grocery run, every mortgage payment, and every dollar in your 401k. You are already inside this market, whether you signed up for it or not, whether you like it or not. So what happens next? That is a $1 million question. If the war stays contained, if Hormuz reopens, if oil stabilizes, and if dollar holds, economists project US growth around 2.2% for 2026. Inflation drifts back towards 2.5, and you get a little bit relief. But if the conflict drags on, if the oil stays elevated, if de-dollarization accelerates, and if a major derivatives player makes a catastrophic bet that goes wrong, we could be looking at inflation of 3.5 to 4% or even 5%. Slowing growth, tighter credit, and dollar under sustained pressure. The next financial crisis probably won't look like 2008. And I'm warning you, it might come from AI flash crashes in oil markets or private credit derivatives nobody is tracking closely enough, or a geopolitical shock that hits the plumbing of global finance at exactly the wrong moment. But here is the thing, and I mean this. Understanding this system is not nothing. When you know how derivatives connect the war overseas to the pump at home, you stop being confused and you start being informed and infocused. You can make smarter decisions. You can hold the right people accountable. You can ask better questions of the politicians and the bankers who are supposed to be protecting you. The people who build this system are counting on you not to understanding it. Today you do. Thanks for watching. If you want to go deeper how all this hits your 401k specifically, what credit default swaps are actually doing in 2026, or whether Dodd-Frank has any real teeth left, drop it in the comments on the notification, because the next video is going to show you exactly what happens to your retirement account when this market gets scared. This is Dr. Adeel and you are watching InFocus with Dr. Adeel. Thank you very much for watching.